Put my chick inside some Louis and some Valentino. Put my bro inside some Gucci and some Moschino. They want my money like it's a casino.
Create Finance. How you lot doing today?
Good, thanks. Good, thanks, Poku.
How you doing?
Good to see you.
Yeah, that's good. Mortgage brokers. Talk to me, what does Create Finance do and how do you benefit the people?
So Create Finance are a mortgage brokerage, so we help residential clients, we help buy-to-let clients. I think Create Finance as niche is helping clients that generally can't get a mortgage on the high street. So that may be they've got historic bad credit, for example, they may have had a default, CCJ. We help clients that are in IVAs, that have been made bankrupt. So we deal with a lot of clients that have probably had a bit of a check and passed. Similarly with self-employed as well, so people that are self-employed that again might not be able to approach the high street. That's generally where we fit in. We help loads of clients in sort of quite difficult situations where they may have been declined at the bank and they come to us almost as like a last resort really, and that's where we step in and help.
Yeah, my audience, a lot of them are self-employed, don't want to be their own entrepreneurs, so definitely this service will be of great use to them. But you mentioned IVAs. What are IVAs for those that don't know?
So an IVA is an involuntary agreement, so basically where a client may have fallen behind with a number of creditors, whether that be credit cards, loans, struggling to meet the normal monthly repayments. So what they do is they may enter into an IVA, and what that will then do is it will help them hopefully manage those payments over a period of time at a manageable level for them. So when you get registered into an IVA, that does have an impact on your credit report and can impact the types of lenders that you approach. So generally, most lenders won't accept clients where they're already in an IVA. So, yeah.
Yeah, and I feel like the biggest problem with people my generation is that it's credit. That's the main problem when it comes to getting a property. That's the main thing they look to improve. But talk to me, you mentioned that you work with bad credit, people that have bad credit. So how much does it really matter to get in a mortgage, in your opinion?
Absolutely, yeah. Credit's important. As part of a credit check a lender does, they'll be assessing your credit profile. So your credit profile needs to kind of be A1 to get the better interest rates on the market. Now, listen, we've all been young, we've all been silly. I was bad when I was young, you know. I was missing payments and not thinking that missing payments would matter too much at all. It matters a lot when you're going to get a mortgage. You need to show the lender that your creditworthiness is good, and the only way to do that is monitor your credit profile. So there's 3 major credit referencing agencies in the UK. If you're listening here, get subscribed to one of them. Monitor your credit, and most definitely, and make sure that you're making your payments on time.
Definitely. So when we talk about bad credit, though, that's people. Let's talk with Experian now. People with maybe 500 or 600 credit scores. How is it that you guys can then make sure they get the lenders or get people in? Is it high interest rates? Is that the trade-off? Or
yeah, there's a couple of ways of looking at it really. Now, an Experian score, should we say 500 out of 999, couldn't necessarily mean that they may not have had any adverse credit in the past. Could be the lack of credit that they've essentially had. Now, what's quite interesting is that a phone bill, a current account, is actually classed as a credit agreement. So if you've got a planned overdraft facility, but you're using an unplanned overdraft, that could contribute to your low score. If you've got a mobile phone and you're not paying your mobile phone on time, that could also contribute to the low score. So make sure that you're keeping in line with your overdraft and you're paying your phone bill on time. To answer your question around the interest rates, now, just because you've got a score of 500 out of 999 doesn't mean that you can't get a mortgage at all. It just means that potentially you may have to look outside the high street, which tends to mean that you're probably looking at a smidgen higher on interest rates. Probably take longer to arrange. I'd probably say your high street ones are the quickest, and your specialist lenders take things longer to arrange. But the problem you've got at the moment is we've got rising interest rates at the moment. So there's not a massive difference, I'd say, with high street rates and the specialist rates. So the gap has been bridged a lot closer
I think as well, sometimes people see specialist lenders as almost being a little bit like a loan shark. They're not. They're all regulated by the Financial Conduct Authority, so they are actually registered to do business. It's just the types of clients that they help are very different to the high street, so they will accept clients with bad credit. So what they're saying is they're taking a high risk on someone that's got bad credit, and because you're a higher risk, they then charge you a higher interest rate to manage that risk. So don't think that these types of lenders aren't lenders that are approachable. It's just they may charge you a high rate, and like Indy says, it's generally the service. The service you can be looking at probably an extra 2-3 weeks maybe to get your mortgages approved, as opposed to maybe someone like your Halifax or your Nationwides. Those sorts of lenders historically have quicker service times, so that's the main difference with the rate.
Yeah, and I wouldn't say that you're looking at double the interest rate either than the highest rate. I think common perception is oh gosh, I'm going to be paying sky high interest rates, but it's never double the interest rate at all.
Yeah, okay. Now that makes sense. And I would say some people like to do things all by themselves. They like to look for mortgages by themselves, or they like to be a little bit stubborn. They don't understand the benefit that you guys can provide by having your network or taking out your time to go look for mortgages for them. What would you say are the benefits then, just for those that don't know, of going through a mortgage broker like yourselves?
100 lenders on the market now. Listen, if you want to go and get your own mortgage, do your own research, and think that you're trying to find the best deal, absolutely, go do it. Our job day in, day out, 7 days a week, is knowing the policy for as many of the 100 lenders as possible. Now, the beauty of what we got is we've got great relationships with lenders, underwriting managers, the ones who make the decisions. So just because the computer says no, we can get on the phone and we can speak to the underwriting managers and say, right, listen, how can we get this case through? And 9 times out of 10, that's why we are where we are today. Is because we've got them direct relationships to get them the deals approved. Yeah,
I think the other thing as well is people have a bit of a misconception and think that the lowest rate is the most cost-effective mortgage. Now, when you've got a lower rate, generally what that means is you might have a higher lender product fee. So typically lenders can charge £1,000, even up to £1,500, £2,000 in some cases. Buy-to-lets can be even higher than that. So you may have products that have a lower rate that has a higher fee, when actually it might be more beneficial to pay a slightly higher rate with a product that may not have a lender arrangement fee. So what we do as mortgage brokers is we look at the term that the deal is over. So typically maybe a fixed rate might be 2 or 5 years. We calculate what the cost of that deal is for that term, and then we give the best, most cost-effective rate to that client. So don't always be fooled by these market leading rates. They're not always the right deal for you to actually go for.
Wow, yeah, no, that's some inside knowledge, definitely. And guys, you have to go towards a mortgage broker to understand things like this. So I think the next thing that people really want to understand and get their head around is essentially the mortgage affordability test. I think in the news, they've removed one of the stress tests from the 1st of August about the variable plus 3%. Is that the rule? I think they're removing one of those.
Yeah, so the banks had a stress test essentially that they worked on for a while essentially, but now obviously with the Bank of England base rate rising, they're getting rid of the affordability test. Now, what we found over the last few weeks or so, lenders have been changing their affordability models anyway, with the cost of living obviously increasing, base rate increasing as well. So obviously there's new affordability tests essentially coming in now. That's another good reason to use a broker. I'd say, like, there's no point in going to do a hard credit check, which could damage your chance of getting a mortgage in the future if you're not going to pass the affordability model with a lender. Take that stress out of it. Speak to one of us guys.
I think that's really important, because us Create Finance, we have access to a comprehensive range of lenders. Some brokerages may have a selected panel where they can only access a certain few. Obviously, if you go to your bank, you can only access their products, but someone like us that has access to a comprehensive range of lenders, we're finding more and more now, especially with rates also increasing as well, we could get a client an agreement with one lender in principle one day, and then the client might take a couple of weeks to actually find the property that they want. And when you actually go to actually apply for the mortgage, the lender that you've applied for before might not necessarily be the best lender 2 weeks later. So obviously approaching a mortgage broker, what we can do, because we can access different lenders, if there is a better lender on the market in a couple of weeks' time, we can just change that mortgage from one lender to another. If you go into one bank, it doesn't. If they change their rates, you're reliant on what that bank's rates are, you see. So it gives you a lot more options and flexibility by having access to more and more lenders. So I think that's quite important when you're speaking to a mortgage broker, is actually find out what lenders can they access. Do they have an access to just a few lenders, or do they have a wider panel to select? So the more choice you've got with anything, whether it's mortgages or loans, credit cards, the more choices you've got, then the better decisions you'd think that you'd be able to then make.
Yeah, no, that's very true. Also, with the other type of tests, the multiplier, the 4.5 times multiplier, what's the highest multiplier that you've seen across your lenders? And because a lot of people worry about that, especially living down south in London or whatnot.
Absolutely, yeah. So what a lot of lenders have now adopted is potentially up to, and if you qualify for it as well, up to 6 times income multiple. That can be reserved for example, giving you come out of university, start a graduate job. If they can see that you've got like steady rise with pay increases over the years, they can potentially obviously look at up to 6 times income multiple, which is great for first-time buyers looking to get onto the property ladder, make that jump and looking to move from mum and dad's. But also, there are other lenders out there. If you're in a professional range, a professional job at the moment, accountant, doctor, potentially up to 6 times income multiple, because the lender can see over the years that your pay will be increasing.
Especially with graduates into like newly professional graduates, they're the types of clients that lenders will generally lend higher income multiples to. So,
and that's gross income.
Yeah, that's it. Yeah.
Lenders have got to be careful, obviously, because we've got rising costs in the UK. Gosh, petrol, diesel, electricity bills. Everything's rising. Sky bill, everything's going up. Netflix is going up as well. So lenders have to be careful. Obviously, take that into account. So they can't be seen to be lending too much at all, because ultimately we've got to pay the mortgage back at the end of the month.
Yeah, no, that's very true. Talking of paying back the mortgage every month, a lot of people kind of complain that if they can afford to pay rent, which is usually above mortgage rates, why don't banks take that into consideration when looking to give them a mortgage? What do you lot think about that?
I agree to a certain extent. However, the lenders have had this affordability model that they worked on for a number of years, and it's there obviously for a reason. There is actually a lender, well, there was talk of a lender a few months ago, and they're still thinking about doing something along them lines. If they can see that you're paying this sort of rent at this present moment in time, so if the rent is, for example, a couple of £1,000 per month, they could look at having your mortgage payment up to that level as well.
I think lenders are always trying to adapt their models, but at the same time, what lenders say is they've got to be seen to be lending responsibly. They don't want to lend money to people that they can't afford to pay back. But I also get the other side's argument, and if you're paying this monthly commitment, they can show they've been paying for a while, then why wouldn't a lender sort of look at that? I think what some lenders do is they look at what commitment you've been making, and if they can see if it's like a borderline case where it might be that one lender might be sort of saying, well, shall we do this or shan't we do this, and actually but what they can see is that you are making a regular rent payment, then that might be a little bit more go in your favour when it comes to the decision. So it can have an impact, but probably not as much as where people are sort of not getting the mortgages that the rent currently shows.
Yeah, no, that makes sense. So just to round up, residential people, what would you say for my viewers, the top 5 things that they should look to work on before approaching a mortgage broker? Or do you believe even when the thought comes ahead to get a house and they have the money to do so, they should approach you straight away?
I would say most definitely credit is so important. Obviously, that can dictate what interest is available and potentially how much deposit you have to pay down. So there's various credit referencing agencies out there. Some free ones, absolutely. Get yourself subscribed to one of them. Monitor your credit, so you'll get alerts every single month. Save. We need to carry on saving. Deposit is so important. So carry on saving. I'd say where possible. Listen, if it takes you a year, 2 years, 3 years, 4 years, 5 years to save, so be it. My first property might look like a long time ago, but I saved for 7 years, so I know how stressful it can be to obviously save for a deposit. Absolutely, enjoy life. Go out there and fulfill it. But if you obviously want to buy a property, you've got to save, unfortunately.
Yeah. I think as well, it is important you speak to a mortgage broker as early as possible, because I agree with Gindy, credit and deposit are massive when it comes to mortgages, but don't always let that put things in the way of approaching a mortgage broker, because there are different schemes available. So we work with lenders where you don't actually need a deposit for a mortgage if you're looking at something like a shared ownership mortgage. So there are certain lenders that will do shared ownership mortgages with no deposit. There's still out there the Help to Buy scheme for first time buyers. Obviously that's going to be reviewed and probably removed towards the end of the year. There's also things like Right to Buy for people that are renting their current house through the council. So there are different schemes available to people. So whereas some people come to us and say, I've not got a deposit, I don't think I can get a mortgage, but is there something that you can help me with? And actually there are clients that we've turned around and helped, even though, as I say, they've not got a deposit in place. And speaking to a mortgage broker, you might not be aware of these schemes, but the mortgage broker deals with these schemes every single day. So I think by approaching somebody as early as possible, even if we can't help you now, what we can do is we can give you the advice and guidance and tell you what you need to be doing every month, so that you can get yourself in the best position possible to get the mortgage, which we're more than happy to do that. And we give no obligation, free advice all the time to clients. We just want to help people to get into the right position, and if we do a good job, then hopefully those people will come back to us in the future, you see. So
definitely. Now that's really, really good, because a lot of people may think, cool, let me just save up but not speak to anyone, and speak to them just before, like they want to buy within the next 2 months, and they'll go to a mortgage broker. But that's good that you guys have mentioned that people should come early as possible, so then you guys can put forward, actually, you know what, based on your circumstance, maybe Right to Buy might be of more use compared to a normal mortgage. But talking of those schemes, Right to Buy, Help to Buy, if you can elaborate more on those, just so someone may understand, oh, maybe I might be in a situation, this might be for me. Yeah.
So, well, first of all, the shared ownership scheme. So the shared ownership scheme is essentially where you buy a percentage of the property. So typically you're looking anything between 25 and 75% of the property value. So rather than buying the property outright, like a normal standard mortgage, you buy a certain percentage. So you could have a £400,000 house that you buy a 25% share of that property. So actually your mortgage then is only £100,000. So I think this scheme works quite well for properties certainly further south that you go, because obviously your Londons, those sorts of areas, your house prices are astronomical compared to further up north, and you might not be on enough money to get a standard mortgage. But if you can buy a percentage of that property, and then what you do, so if you buy a 25% share, for example, you then pay rent on the other 75% to the local authority. So you almost have two separate payments, but it helps people get on the property ladder, because if the more percentage that you're buying of the property, the better. But with shared ownership, so you might buy a 25% share, but then in 2 years' time, you might then be able to buy another 10% share, so you then own 35%.
Based on saving.
Not saving.
Yeah.
It can be savings, but it can also be that you raise further money through the mortgage.
Yeah,
you might be earning more money, for example. So you might have got a job promotion or just general inflation, be able to earn more, get a better mortgage.
Or naturally, the value of the property may increase, and because you're on you're paying your debt down, you're building in more equity. It's classed as what we call staircasing. So then you might start on 25%, like Aaron said, you're going up and you're earning, or you're buying more of a share of the property. So essentially, you're paying less rent.
Yeah. Until you get to 100%, which is the goal. Once you own 100% of the property, great. So it's just a way of definitely getting in. There's, but yeah, so that's the shared ownership scheme. We've got the right to buy scheme.
Yeah.
So right to buy scheme is where you, if you're currently a tenant through the council, you may have been there for a number of years. The more years that you've been a tenant, the better discount that you can get, typically up to 65%.
Yeah, 60, I think it's 60-65%.
65% of the property value. So the longer that you've been in the property, the bigger discount that you get, which again is great because you're buying a property at a reduced price. You need to keep in that scheme for 5 years, but then after 5 years, the property is yours. So if you've got even if you're buying a property at 200,000 and you've got a 50% discount, you're buying the property for 100,000, but in 5 years' time, you've got a property worth maybe 200,000 or more if the property has grown in value. So it's a really, really good scheme where you can own a property, get it at a good discount, and really benefit from that in a few years' time. So,
I think I'd probably say that Help to Buy is probably the most popular scheme that we've had over the years, and we've helped so many clients get on the ladder through Help to Buy. It's almost quite sad it's over actually this year, because there's been so many first-time buyers that benefit from there. So you put a 5% contribution in. It was available for new build properties only. Inside the M25, you get a 40% discount. Outside the M25, it's a 20% discount. Rules have changed in the last year or so, where the maximum that's available on a Help to Buy is based on geographical location and average prices of properties within the area, and it's only eligible for first-time buyers. So there's a few more, as Aaron said, there's a few more months left on that scheme, but any new build properties, as long as you've got 5% deposits, 20% as 20% or 40% as a interest-free loan for 5 years, that you pay £1 a month just to service, and then interest is payable after year 5.
Wow, no, that's big. That's big. And I wanted to now move on to self-employed. You know, a lot of my audience are self-employed. They want to get their own properties. For them, I guess simply, well, you tell me if I'm correct or wrong, but is it simply through the limited company paying themselves the right amount so then they can fit the multiplier, or is there other creative ways that they can do so? Like, should they buy through a limited company, for example? Like, what do you?
Yeah, being self-employed, it can have advantages and disadvantages, because you're trying to balance both ends, really, trying to minimise your tax as much as possible. Also, as you said, give you the best income multiplier or affordability test, so you can go and get that loan and that house that you actually crave. Now, for limited company directors, there's a number of ways that lenders will verify your income. So your standard one tends to be salary and dividends. Everyone gets a tax-free allowance every single year, and then whatever dividends you take out at the end of the year, lenders will tend to potentially use a couple of year average. Some lenders will use latest year's figures only, and then they'll use the income multiplier or the affordability test based on that. Now, the other way of looking at it, if your business is profitable, limited company shareholder, you take a certain salary and you top it up with a certain level of dividends. What lenders can use is the retained profit element within that limited company. So you might not have a lavish lifestyle at all, or you're trying to save as much money as possible within the limited company. That's absolutely fine. What a mortgage broker will need is your limited company accounts, full and finalised accounts. They'll look at the retained profit within the business, which tends to be higher than the dividends that's been extracted out of the business, and then they can essentially use that for affordability. And you don't need to extract that income out at all, as long as we can see it on the company accounts. There's lenders out there that will take that, which tends to work quite favourably if I'm honest, because then it means that you're not paying that high level of tax.
Yeah.
Just use that income for a mortgage application.
Yeah. Anything you extract from your business, you have to pay corporation tax on.
Yeah.
So we have so many clients that they don't need to take that money out of the business, but they think that that's going to affect the mortgage, and it's not. As I say, there are lenders that will look at just how profitable that business, because they know, the lender knows, whilst you might not have taken it out for tax reasons, if in future years you need to take that out to repay your mortgage, then you're in a position to do so, you see. So yeah, so it's about approaching the right lenders. So some lenders won't use that, but other lenders will. And again, that's where a mortgage broker comes in, because you might go to your bank and they say we can only use your salary and dividends, whereas another lender might use your net profit and.
And you only need to have 1 year. So there's lenders out there that will just use it on 1 year. Yeah. So one of the common myths is, so we're busting myths now, right? So you need to have 2 year or 3 year books. No, that's just a lie. So lenders out there that will potentially consider you even with like 1 year's full finalised accounts.
Wow. And looking forward, or looking back towards normal, like people just looking to get a mortgage, how much of bank statements do they go through just for a normal mortgage, would you say?
3 months. 3 months is the standard lender requirements. They can request more at their own discretion, but for standard, most lenders will want 3 months.
Yeah.
So what would you say to the audience, things they should not be spending their money on leading up, 6 months leading up to applying for a mortgage? Like, what are some hazard items?
I'd probably say like red flags for a lender would probably gambling transactions. Now, you know, we all like a bit of a flutter baby at the Grand National horses, maybe. However, if you're betting every single day, lenders, can see that potentially as a commitment. Once they factor that into affordability, it could knock the application out. We've seen some horrific examples, shall we say, let's just put it of gambling. So I'd probably stay clear of that. And payday loans as well. No matter what I've been told in the past, payday loans do not improve your credit profile whatsoever. So please don't take out a payday loan or any short-term lending at all.
What about any other credit products, like maybe like taking out a credit card or a car finance on PCP, like maybe within 6 months? Should they look to avoid that?
The only thing as brokers, would be concerned if obviously you're taking out car finance, because that can have a detrimental impact on how much you could essentially borrow. Because obviously car finance agreements at the moment tend to be a bit higher, so that will be classed as a financial commitment. Credit cards, if you want to build your credit profile up, there's nothing wrong with obviously taking out a credit card with a very, very small limit on there. As soon as you're spending on it, making sure that you pay it off, so you're not incurring that interest, that can build trustworthiness with a credit provider and help obviously increase your credit score going forwards.
I think the other thing as well, especially when you're looking at overdrafts, is it's really important that it's not a problem having an overdraft. It's making sure you stay within your means. So don't go over your overdraft limit, because as soon as lenders see that you've been exceeding your overdraft, again, that's a red flag to them, because they see, well, if you're exceeding your overdraft without having a mortgage, as soon as we give you a mortgage, how are you going to pay this back? So, like Andy said, gambling, make sure you keep your account healthy, and if you use an overdraft, that's fine. Just make sure you try and keep away from your limit on your overdraft, and make sure certainly you're not going over your overdraft limit. They're the sort of things.
Yeah, because ultimately, if you're going over your overdraft limit, you got direct debits. Your direct debits will start bouncing, and you don't want that.
No, definitely not. That's not the way at all. So some people, when it comes to the affordability test, they would rather do it with a partner just to combine and make it worthwhile. What do you lot think about, bringing someone else on? Like, because again, it attaches to your credit file. So what do you think? Do you think it makes more sense for someone to do it alone or to bring a partner involved? What do you lot think about it?
I'd say best advice normally is if you're going to buy property together and you're going to live in the property together, most definitely makes sense for both of you to be on the mortgage. There may be where probably doesn't have the best credit profile at all, but applicant 2 is, totally fine. In that case, you might want to consider just having applicant 2 on the mortgage in order to get a better rate of interest. But what I will probably say is just because number 1's got bad credit and number 2 hasn't got bad credit at all, doesn't mean that if they have a joint mortgage, that number 2 will automatically get bad credit. As long as you're making your credit payments on time, that's absolutely fine. There isn't many examples out there where it can potentially have a derogatory effect on one another.
Oh, okay.